All right, good afternoon, everyone. We're going to get started here with the fourth installment of our Venture Capital for First-Time Founders. This is the culmination of 4 events. It's our final chapter, so to speak, but it's the last of 4 events that kicked off our Investor Studio series. So if you're in the back, if you're meandering in through check-in or not sure where to sit, there are some prime real estate seats here in the second, third row. Come on down, don't be afraid. My name is Dr. Christine Galeb. I'm the Senior Director of Entrepreneurship and Innovation at the ION, and it's my pleasure today to introduce a little bit about our programs and then turn it over to Neil and the rest of the panel. So real quick, whose first time at the ION is tonight? Whose first time at the ION is tonight? A few people, yeah, awesome, yeah, raise your hands high, don't be afraid. We give a round of applause, that's awesome. It's great to see you here, thank you for coming. We do a whole bunch of events for entrepreneurs, for founders, for people seeking to upskill. We're Houston's tech and innovation hub, and so we're thrilled that you're here. So if you have any questions on any of our programming, you can feel free to look at our website, ionhouston.com, but I do want to point out just a few events tomorrow and Friday that we have. So tomorrow, we actually start another series in our Investor Studio series. It's called Venture Capital Deep Dives. And so it's taking some of the topics that we discussed in this series and going a little bit deeper with them. If you're interested in that, you can sign up through our Eventbrite. And that is more of a seminar style, deeper dive conversation where we talk through some of the terms that you might have heard the past 3 sessions. On Friday, we have an event called Cup of Joey. It's at 8:30 in the morning, and it's right up here in the lobby, so it's open for networking. No matter where you are in your tech or entrepreneurial journey, you can show up and you can meet someone, make a connection over a cup of coffee, and build purposeful relationships that way. So that's my advertisement for today. Before I introduce our drink sponsor, I'm going to go slightly off script and ask that we give Neil Dykman a big round of applause for hosting this series. So Neil, come on up here just for a second. We have a little something for you. So
am I going to like it?
I hope you'll like it. You better like it, right? That's all we had.
Houston on the cusp of a changing America.
So that's prophetic city.
We're doing the changing.
We're doing the changing. So it's a good book.
Thank you very much.
Yeah, you're welcome. There's also mints in the bag.
Ooh, I like mints.
So
Can I stay up here now, or are you still in charge?
I'm going to introduce. Yeah, but you can stay up here. No, you can stay with me. It's fine. Okay. I just wanted to shout Neil out because he's provided so many nuggets of wisdom these past 3 sessions, and it's important that we have these conversations with the experts that he's brought on to help us wherever we are as we kind of break down what VC funding is, and if we're a first-time founder, how do we go about doing that? So a big thank you to Neil. So now I'd like to introduce our drink sponsor for tonight. Immediately following our hour-long talk, we'll adjourn up to second draft for drinks. And tonight's drinks are sponsored by Softtech Venture Fund. So Billy Grandy is the managing partner of Softtech Venture Fund, and his bio is as follows: consulting, sales, and operations expert. Lifelong entrepreneur, founder, graduate of Techstars, Disney Accelerator, Dubai Future Accelerator, and Sprint Accelerator. He's the head of Softtech's Venture Studio, and I will call him up to the stage to introduce some of your speakers for tonight. So let's give it up for Billy.
Hey, what's going on, everyone? So you guys are in for a treat tonight. So we have 2 great speakers coming out. I'm with Softtech, and we have a venture fund and a venture studio here in town. So for any of you early stage entrepreneurs that are looking for help building your business, maybe helping scale your technology, you can come see us at the end. And we're going to do the thing tonight we love to do, which is create collisions and have drinks. So after the speakers are done, up there, last call will be at 5:30. So make sure you get a drink before 5:30 because we're paying the bill, and after that, it's on you. So without further ado, the two great speakers, we have JR and we have Joe. They're going to come on out.
All right, well, thanks, Billy. I think we're supposed to sit now, all right? Hi, everybody. It's great to be here. How many people here tonight are founders of startups? All right, how many of y'all have raised capital so far? All right, some of y'all. I think tonight we have Neil here, who's going to be our host, and he's going to talk about the 7 mistakes that founders make in the process of building company and working with investors like himself, like me, like Billy, like others.
So
And
JR,
then
there's only 7 mistakes?
We only have enough time to get through 7.
we're probably only going to get through 3. But the idea is for Neil to talk through. I'll give some commentary, and then Joe will keep me honest from the operator perspective.
That's awesome, because I'm
And-
used to you keeping me honest.
Yeah, so the irony here is and Joe could tell the story, but we first met in 2016 at Station Houston, and then we led your seed round in 2018.
Wait, you fast forwarded. Actually, when we met, you asked me about the business, and after I went through a long pitch, JR said, Joe, I think that was probably the worst pitch I've ever heard in my life. Something to that effect.
It wasn't
That
far
encouraged-
off.
That encouraged me to show back up again.
But there was enough there in the years to follow where we've been on the journey with Joe and Lion Guard now since 2016, but invested in 2018 and made 4 investments in the company throughout that time. So,
Thank you.
Neil.
So you know every mistake Joe's made.
No, he doesn't.
No, I don't know that much detail, but
All right, so guys, we're very lucky to have these two here, and this wasn't going to come together this way. I did not know how our final format was going to be. JR was supposed to do the fund one earlier, but the time schedules didn't work out, so we got Andrew to come help us, and then Joe has been ignoring me for 3 weeks, and he emailed literally yesterday saying, hey, sorry I'm late. I can do tomorrow if you still want, and I'm like, great, and apparently he and JR already knew each other, which I did not know when I invited each of them for different events. And so we've got just a really good crew here. Yeah, because literally I've got Joe, who happens to be the famous Joe, running the largest startup in the Houston Innovation District. And apparently almost tenant number 1 of the ION, or number 2, one of the first 3. How many people y'all got?
It was quiet. It was quiet here when we.
I mean, you have the
There's a
CEO of
construction
the year who's been Houston's fastest growing company for 2 years. So, Joe, you know everything. So I don't think Neil or I are going to say much.
Right. And then
tonight.
know
we
every
just
mistake.
we randomly happened to get one of his first investors who's seen every body he's buried. So just like last week, where we had Brad and Trevor, I'm going to walk through, and I've been a founder half a dozen times, but I'm now a VC, so I lie to you. So I'm going to walk through the mistakes that people make, and I get tired of telling them to them one by one, so we're just going to do this on video and publish it. And Joe, we're going to see how many of these mistakes he's made, thinks are real, and JR keep both of us honest here. So I'm really excited to finally get this group together and get the famous Joe on stage at the ION, downstairs from his world headquarters, coming out of his ivory tower. We appreciate you, Joe. All right, so remember, first talk is how we do a startup. Second talk was how venture funds work. The third talk was how to raise money in game VCs. And this one is, okay, you got some money, how not to screw up your startup afterwards. And everybody makes the same mistakes. I've made many of these 2 or 3 times in a row before I learned. So I've literally held every executive job in a startup very, very, very badly. Yeah, and a couple of them, it was the 3rd startup before I stopped making the same mistakes. It's hard. There's a learning curve just like anything else. Yeah, so we're gonna go through this here. And then afterwards, as usual, we're going to adjourn to second draft to drink. And we managed to con another firm who actually writes checks into paying for y'all's drinks. So if you're here as a startup and you can't learn how to run a business from Joe, and you're not happy that I've gotten you investor after investor on this stage to go hit up, I mean, come on, then just go home, right? You're not going to be in startup land for very long. But we're giving you the opportunity to get done what you need to get done. And behind us is the free Ion space where if you need to run your startup, you just show up, sit down, and start working. That's it. You need nothing but the people we've gotten on stage and y'all. All right, so the talk is 7 mistakes founders make after funding. The first one is real simple. It's not starting the next round 3 hours after you close the last one. One of the other companies we just funded not too long ago, they raised a big fat round. And the close pitch on the timing was, Neil, hey, we need to check in. We got this done. We're literally going to go start around 5 times this size, and we're going to start it next month. So I need the check closed now so I can go do that. Yeah, these guys are on a treadmill. They're going for broke. They're swinging for the fences. And, they're not stopping. There's no rest on your laurels thing. Yeah, so our theory is it's kind of like the ABC, they always be closing. If you're a founder, your job is to sell stock and then sell your company and then sell employees in your company. So mistake number 1 is you take some time off in between rounds and you're not in sale mode at all. And then, years gone by, and they're like, I need to go raise some money now. My runway's shortened. And you haven't built those pre-marketing relationships that we talked about in the last one. And now your next round is hard. The old rule, you make your money on your A and you lose it on your B. Joe, did you lose your money on your B, or did you manage to get through this process, and when did you start?
I learned the hard way after the seed stage round. And
JR didn't explain it to you then?
well, he set up, he was involved with Station and, bringing all the folks to do the meetings. And so I was taking a lot of those meetings and really needed it to take a concerted effort in terms of continue to build some cadence around those meetings. And right as I was getting closer to the Series A, I started to realize why it was getting really important to get out in front of this situation and describe this mistake that you're talking about, and really got a whole lot better post-Series A around how to think about having those regular meetings and meeting with folks that are at that next stage and understanding what's ahead and what milestones that we want to get to, and work our way backwards from there.
Yeah, and I remember we introduced you to Will at TDF after meeting him at the SaaS CXO Summit. Mm-hmm. And so that's how that connection happened. But I think to Neil's point, if you're raising money when you need money, it means you didn't start building relationships at the right time, and you're always working backwards in doing so. So socializing who you are, how you think about things, and previewing that alongside of investors is the way to...
Remember, that was literally the rule in the last one. Get the pre-marketing phase done. That's phase 1. That's what he's saying. It's the same stuff.
Yeah, so if you're doing that, then you're bringing people on the journey with you to naturally dive in, be curious, and see how they want to partner with you. So that's, I think that's the way we think about it. And, one of the ways that we think about how do you bring people through that journey is, create a weekly or monthly cadence of talking about what you're learning, what you're doing in your business, and use that to build your distribution and let people know how the business is learning, how you're recruiting people into the business, and and through that learning process, what do you have to go do next in pursuit of the bigger vision?
I'd say one thing I would add to that is that when you're doing this process of really marketing or really connecting with organizations and sharing with them,
selling stock
yeah.
to dumb investors, yes.
The other side of it is also being very deliberate about asking them what they're looking for and understanding whether there's a fit around whether they would be your prospective next stage investor. Not being shy to ask them, what stage do they invest at? What are the things they're looking for? What milestones that you need to have achieved? Because a lot of times I found myself talking to someone who's a much later stage investor, not realizing that that investor was also building a pipeline for their future state. It's important for you to know, where does this investor fit in my timeline and my landscape in terms of that next stage of investment.
That was in our rules of how to raise money the last week. Okay, mistake number 2. hiring the org chart upside down. And what I mean by that, it's like, look, you get excited, you got cash, and you're going to turn cash into people to go build some product and sell some stuff. Great. Which people do you hire? Which positions do you fill? Yeah, I'll get deals, they'll come in, and I'm looking at the company, and I'm like, man, there's not a single person at the senior level who's ever held the job title they've got here at a similar size company. Great, if you're all 24 years old and you've never held any jobs, and by the time you're 40, you'll have had those jobs, fine, maybe. But I'm looking at it, I'm like, this is a mismatch, and almost always, the right move is the general staff model. You want to be able to scale quick. You don't need to go get just rock star individual contributors. You got to get some people that as soon as you give them some resource, they can do the work now, they're doing the planning, and they can blow out your team and scale when it's ready to go. So you hire a couple engineers and you don't hire someone who can run engineering and who is also an engineer, and then you bring that person in and they're like, your engineers aren't very good. Or they're like, look, I'm coming if I can bring my team, or your first engineer wants to be in charge, but they don't have the management skills to do it, or something else. You've done your org chart upside down, and it's going to catch you on the next round.
I'd say the mistake that I personally made is the areas that I knew the best are the places where I was the most upside down, and did not think far enough ahead. And so,
like literally, you knew how to run that function, so you didn't hire the executive to run it because you could just do it yourself on the side.
You bring up engineering; it's an area that I have, it's native to my background in terms of like things that I'm very familiar with, and I would say we went bottoms up over time and realized we needed to get out there and find someone who, I don't know if Colin's here or not, but there he is. There's my SVP of engineering right back there.
So you had to go eventually find your Colin.
There you go.
I mean, imagine if you had Colin back in 2016, 2017.
Yeah, we'd be just we'd be done. We're done.
All right.
Well, to that point, I think to what Joe and Neil said, you think about folks who could lead functions, right? So don't hire folks to do jobs to be done, but folks who could build capacity, and don't overinflate everyone's title. You don't need CFO and CRO, all these things. Just you got your head of product, you got your head of growth, you get your head of engineering, and build on that. But build the capacity. Where you're going to bring in athletes in the business, people who are just really smart, really dynamic, can move fast. Think about those as probably one or two of those specific roles, super, super early. But otherwise, it's where could you build capacity? So if you're the founder, you're able to push on the business and truly empower the talent that you have to go think through and put all those pieces together as a team.
So what JR is really trying to say is, Joe, you spent too much time running engineering and I needed you to run the business. I know you can run engineering, but you got to pick, be the CEO or run engineering. So
Joe and I were sitting one day in Station, and he pulled out an org chart, and for each function it said Joe/Vincent, Joe/whoever.
I've seen that org chart before.
Do you remember this?
Yes, it's a classic situation.
And it was Joe, what's wrong with this? And we got out the red pen. It's all right, Joe can't do this, and Joe can't do that.
So we referred to it as the $1 Million a Month Club. If you do it the opposite way, you will get to $1 million a month, and you will hit a ceiling, and you will smack your head against it, and you are done. You cannot grow until you build an entire overhead layer on top, which is hard to build at that layer. So you can get a business built by yourself with 30 direct reports until you hit that ceiling. Okay, number 3 mistake. Leaving sales and product management hires for later because you're not ready. We know our product or our tech, and it'll be fine. I had a couple of rules that we used to use. Revenues. Number 1, revenues cure all ills, right? So you kind of need to overinvest in the sales and marketing functions compared to what you think you are in the early days. Number 2, nothing good can actually happen to your company unless you're in front of a customer. Bad things can happen, but it's really hard for good things to happen because your whole existence is about making those happy customers. And over and over, and I did this 3 times, oh, I'm a good sales guy. And I am a good sales guy. Yeah, I can drive revenue, I can close business, but I can't run the business and be my own VP of sales. And just like Jimbo Fisher, if you're calling your own plays and it ain't going well, who the hell are you gonna yell at? You gotta have the talent in there.
I think that's the throat to choke. Is that what you're saying, Neil?
You need a throat to choke, right? You need to be able to separate yourself out, and you need those bodies. The story I used to tell at Shell, trying to get this through people's heads, if there's $100 needed to bring a product all the way to market, 50-50 is about the engineering, the product manufacturing, getting it made and ready to sell, and 50%, $50 of that is about sales, marketing, go-to-market, whatever, getting it sold and delivered. And of that 50, the first 50, maybe a quarter is R&D. So if you're 80% through your R&D, you've done about 10% of the spend. And especially if you come from a technical background, you tend to not realize all that second 50, and you leave it until the product's ready, or you think it's ready, and frankly, you don't have the horsepower to go get your product to market. So that was the rule I should tell people. Whatever dollars you're spending on making your product, spend an equal dollar on selling and launching the product. And if you're not spending that ratio about right, step back and just check that you're doing the right things.
So 2 thoughts. One, get in front of your customers more and listen more versus tell them about your thing or wanting to show off, your software, your hardware, your app, your product. So be curious, go ask questions. I think if you say line guard, right? Like learn and adapt, listen and learn. So that would be the first part. And then the other piece is, I think a lot of folks hear about product market fit. Think about, you're ultimately trying to get to product, market, distribution, pricing fit. And what that means is you've got to drive some orchestration of being in front of customers and understanding how to meet them at the right price to deliver value, ultimately towards a way of finding distribution at a certain scale, which you're not trying to scale early on. You're not trying to do things at scale early on. But that's ultimately the culmination of those pieces that allow you to efficiently and effectively build a business that investors are going to want to help you build and then ultimately participate in building. What do you think about it, Joe?
Yeah, no, I think on this topic, I'd say I went 50-50 on it. On the sales side, I felt like I came in fairly early. On the sales, individual as well as a sales leader, that really.
You did a great job on that, like bringing in like someone really senior to help on the sales piece.
So this kind of violates a lot of the little SaaS rule playbook these days, which is make the founder sell until you got your first million. And I was always of the view that, look, if I've got a great technical founder and they're not a salesperson, they've never done it in their career, why am I making them do their weakest suit? They just need to pull. So I kind of put this back to the general staff model. And like, if you are a technical founder and that's what you're strongest at, absolutely bring in some help, your caliber in the beginning. Now, I know that, JR, that kind of violates a lot of the venture rules that people tell you these days when you're kind of talking your little portfolio. But I think it's good for the venture capitalists to follow those rules. And if you're a founder, I want a sales guy from hell on board with me day one if I'm the coder.
Well, I think there's 2 parts. You want to jump in?
I was going to add the one thing I would say is not being detached from that sales process. Being very involved with it. The sales leader or sales individual you're hiring, they're a great seller. You should be bringing the DNA and not separate yourself from that selling process, because largely you're going to miss a ton of insight early on if you're not part of that process. But having the stamina around the sales process, that's where I think a technical founder will sometimes, they're multitasking. They're switching gears, and the level of insistence and follow-up and really thinking in terms of opportunities, how you push through, those are the things that having a dedicated salesperson is really going to help with. And they're going to help learn, they're going to learn quickly about what's going on in terms of product market fit and what's the right way to position it.
Okay, so to flip the product market fit, we've got the next mistake that we've seen over and over is not planning for success, right? founders a bit afraid that they don't have product market fit, they're not ready, or they're not quite sure when they do. And so things like, I need space if I'm manufacturing, or I've done my pilot, but I don't have my manufacturability done in mass manufacturing, the customer can't buy, or I'm launching my MVP and my product, but my infrastructure is not capable of handling it. And they get success, and it's like, dude, we bet on you for success. And then there's another year of just setup because they didn't have that second part there. And so I've seen companies do this over and over. They get the win, and the win doesn't translate into the rocket ship without another year of my cash. Agree? Joe, you didn't like this one when we talked earlier.
I'd say that one thing I would add is that over-engineering the outcome that you're trying to bring to market can cause this delay at times. You're trying to get to the perfect outcome rather than what is the immediate, what is that minimum viable product, minimum lovable product that you're actually putting out in the market and getting it there. I can't speak to the manufacturing side. Ours is pure bits and bytes in terms of software, so the capital outlays aren't there with regards to that. But I would say that over-engineering concept and waiting too long can be an issue. I would say I wasn't as this one is the one that I would say I was not as tied into. So I felt like I went in fairly quickly, and in some ways it ties into your next question.
JR, so you've done life sciences and medical as well as some software and some other sectors. Does this mistake resonate or not?
Yeah, I would say, how many people here know what ideal customer profile or an ICP is? Okay, this is one of the most important things you could do early on is really understand who you're trying to serve when, and that all customers are not the same. And I think to Joe, one of the points I think Joe was alluding here was if you understand that folks have different needs. They're gonna have different needs on what the product capability is, maybe what other platforms you have to be integrated with, what specific value proposition.
That's a big one. My stuff works, but customer can't buy it because it needs these integrations and we don't have them, and I got 6 months to do and I lose a whole year of revenues.
Yeah, so knowing that versus a customer is a customer is a customer is a really important piece ultimately towards getting repeatability, and then how you go and acquire and service those customers. And I would say over-index on that. And those are things I think that other investors are going to want to dig in to really understand. So if you didn't do that, there's probably a workshop to have. You could go to one of Wade's. Probably
Wade
Pinder's
Wade's our
here.
product guru.
He runs a Houston product community. I'm sure they've either done a Saturday session on it or will at some point. I think he did something on customer journey mapping a few weeks ago. Yeah, so this is oxygen. Go encourage y'all to go do that.
Okay, mistake number 5 is kind of the antithesis of this. It's, look, in my view, startup going through life, and there comes a time when it needs to either step on the gas or step on the brake. And knowing when to give it gas and when to give it brake is literally the hardest decision ever. And half the screw-ups I've seen are the companies stepping on the gas before it has product market fit, for example. It's just burning cash to no end. Or they've stepped on the gas and they need to step on the brake because it's not working and they need time. And so they should be going back to their investors saying, hey, I need a little bit more cash. They should be cutting some burn, letting some people go, buying the time to figure out when to step on the gas. And this one's the art rather than a science, but half the mistakes I've seen, it was gas or brake at the wrong time.
Agreed on that one. So, and that's excitement about, when you really think you've got traction, and having the ideal customer profile is so important because it creates such focus for you. Like having an ICP allows you to really focus in on what's the valuable outcome you're trying to get to. That allows you to not over-engineer. It allows you to really deliver something definable. But past that, there's excitement you get. After funding, you've got the ability to really hit the market and say, okay, I need to hire another 3 salespeople. I need to go do this. I need to go do that. And so I would tell you, really, hone in on whether you're getting the traction. Don't lose track of the end customer in terms of, as a founder, really understand where you're seeing the light bulb moments from those customers, and get in with your current customers and really understand where they're deriving that value. It really helps you build your roadmap.
I'd say the more annoying mistake is, look, you need to step on the gas. We're here to win, not just to get a single or a double. You got it. We like what you're doing. Your investor's happy. We think there's a customer there. You need to double your burn and double your team. And it's uncomfortable, and you've never done it before because you're a first-time founder and a first-time CEO. And you need to give it gas and run straight at the brick wall and bet we can knock the wall down before we get there. And I've seen companies just get caught from behind and dragged down because they wouldn't give it the gas when they needed. And it may be they need to go tell their investor, hey, I'm going to need to double the cash. I got to pull them off my round now, not next year, because it's time to go. So our view of the mistake is it's almost as bad not to give it gas when it's needed. You're not playing a startup to be small. You're playing a startup to win the entire board.
Yeah, so one way of thinking about this is if you've got the right investor, they're going to be investing in you, but they're going to be funding your plan. And chances are you've built the plan together, or at least you've built alignment of how you're going to deploy those resources and how to think about that piece. And then you're going to get signals, ultimately, once you start executing, as to whether or not that's right. Whether or not those core hypotheses turn out to be true, whether or not you get the outputs from those types of investments that you've made turn out to be true. So I'd say if you're raising, and especially we've got a lot of earlier founders in their journey here, it's about finding alignment, and kind of building those pieces together. And being honest, being objective, it's like, when do you really have fit? If you just want a will that, I want this to fit, I believe it will, that's not a great place to run a company, versus really be objective. It's hard and difficult and complex as that is, to then understand, okay, here's the times where we should be investing and trying to drive this level of growth because we found fit.
JR, I don't know about you. I mean, I tell companies before we fund them, this is what I think your plan should be. And if you don't like what I'm saying, you better not take my money, because I'm not going to change. I'm trying to signal to you, this is how I'd like to run the business together. And then afterwards, I tell you as we go, I'm hearing what you're saying. I'm reading data points. And I think you need to give it more gas or brake. I tell them all the time. And I'm not sure my startups trust me, because they're not sure whether they can. But yeah, and sometimes you'll have an investor who's just dumb as a box of rocks, and they're telling you the wrong signals because they don't know what they're doing in your sector. And you got to judge, is my investor, A, telling me the truth, right? Do they have the courage of their own convictions if we're going to step on the gas and I'm going to need more cash? Do they know what they're doing, or am I smarter than them? Yeah, and do I need to be listening here? And if you get that right, you make a lot of money. You get it wrong, you get misalignment, and you're in trouble.
So as part of closing your investment, if it's let's say it's a fund like us or another institution, part of your term sheet, there's going to be this condition of closing. And part of that is going to be agreeing on plan. And then this part of agreeing on plan pops up every year, and really every quarter to a certain extent, as you're course correcting. Because I'd say, here's an insight. Your investor is your partner. They're not just, if they're early and they're just throwing money at you, maybe that's great, maybe it's not. But your right investor is truly your partner, and they're going to spend a lot of cycles working with you, trying to figure these things out. And I think it's not to be right. Our objective isn't to be right, it's to get it right. And work with our founders, our partners, to go and do that.
You can only be right all the time if you change your opinion when you're wrong.
What do you
Nice.
think, Joe? You can
That's
fact check me on it.
Yeah,
You like that one?
That's a good one. I'll tell you the thing that I was going to say is that it comes down to this term, and Colin will laugh about this, is we use this term spreadsheet jockeying. And when you're putting together that plan and you're thinking about putting the pedal to the metal, it comes down to that up and to the right curve that you're creating in that Excel spreadsheet. And you have to know that it's believable. It's that you can execute on it, and it's something that we face every year through the planning process to understand. Okay, is this thing executable? Is everybody aligned to this? Is it not? And it is challenging. It's challenging every time. And in the early days, it's very tempting to put numbers down and know that post funding, you are held accountable to that plan. You're executing on it. It's not just a spreadsheet. It's the thing you're
I had
working
an
towards.
investor years ago who they called it the red shift because in the Excel template they had, they would track and had been tracking every deal they'd ever done, what the projections were and then what the actuals. And it just so happened in Excel in the little chart template, the second curve was red. And so they'd manage us you to the red shift, not to what you said, but to their kind of rational expectations of what you said. But not everybody investor does that. All right, okay, so move into kind of a slightly different, next big mistake, these are more personal, right? Number 1, or number 6 in our little list here, micromanaging A players. Like, I've seen it over and over, it drives me up the wall. I got a new founder, new CEO, they're hiring good people, and they want to tell them what to do, and they run off the people, or the good ones won't come because they can smell it. And and maybe my founder's awesome, but if they don't let go of whatever that function, pretty soon I can't keep the talent, and I'm tearing my hair out because I've got a great founder who's a bad manager. Joe?
Yeah, I mean, it goes back to that same topic of what areas are you most familiar with? You're going to tend to micromanage more there.
Well, stop that.
And yeah, well, you got to let it go, right? And you got
Let it go.
Yeah, let it go.
Colin, is Joe a good manager? That's probably the proper answer for a public forum.
I think I give Colin some room to run. I don't feel like I get into his business much.
If someone's worth like investing in to come into your company, don't micromanage them at all.
If you have to micromanage them, you needed to hire somebody different.
Be super clear in what you're trying to do. Like lay out the way that the basis of how we want to compete, of what our different is, what we're trying to do, and then provide support. Be clear. I'd say that's a piece that I continue to learn more. Is the most important thing I think as a leader is just being absolutely clear. Saying things in less words versus more, and being as clear as you possibly can, whether it's to an investor, whether it's to someone that you're recruiting, whether it's to your partner, whether it's to your spouse, like whatever it is, just be clear.
Okay, so JR, you're literally leading me to my 7th one, right? 7th mistake.
On demand.
I'm going to get to the. Have you ever heard of an EVP email? EVP, Executive Vice President. So somebody explained to me when I was at Shell, Neil, you write emails like an EVP. And I'm like, what does that mean? Well, they're like one line, like, do it, yes. Here's the direction. And then you go back and look and farther down the org chart, the longer the emails get. Yeah, and some of that we figured actually boils down to a confidence thing. My number 7 mistake is actually one of the 2 big ones for us. I've got an 8th we're going to go through here in a second, and it is you let your insecurities screw up your business. What I mean by that is I got a CEO or a founder on, they got money, and they're scared to tell me something's going wrong. They're not giving me the bad news. They're scared to pivot. They're micromanaging because they're afraid of giving up the control. And half this stuff, they're not coachable anymore. They were day 1, but now they're not day 2. It's all an insecurity thing. We all fight it. But if you are a founding CEO and you are insecure in the way you make your decisions, you let your personal insecurities and how good you are bleed into those decisions, you will screw up your business. You will die. At the best, you'll hit the $1 million a month club, or you'll get fired and replaced and your company will rocket ship. And I think that EVP email thing was the same thing. Those EVPs, they're at the point where it's like, no, we're going, right? And everybody else is trying to defend their whole argument, their whole point in a whole email, in the same email. And I'm like, no, we need to all act like that EVP email. Let's just do it. Have some confidence.
We use Slack now, so we don't use email internally.
Dude, it was
So
Shell. Come on, Slack
yeah.
was illegal. They wouldn't let us use the cloud.
We speak in less
That's
than
not a joke. That was.
140 characters. That's all you get. So
We run
no,
our
no.
company off Slack as well. It's an awesome little platform.
Yeah, no, it's a good point as far as just the insecurities potentially holding you back. I tend to, actually, do a lot of my decision making in a collaborative way in terms of with the executive team, and it's a style that I have in terms of the approach I take, and it's something that is always evaluated very closely, and it's something that when you think about your style and your approach, you just got to lead with that approach.
Here was the next insecurity problem that we'd seen, right? You're paranoid. You won't share with your investor. You won't share with the next investor. You won't share with your customer. You're afraid people are going to steal your stuff. You're not confident that your stuff's actually that good and you can outrun everybody anyway. And so we turn a home run into a single or a double because you weren't willing to fly a little closer to the sun when it mattered because you just didn't trust. I don't know, JR, have you seen that? I mean, this is a big one for us.
Yeah, I think it's live in the light. From a standpoint of your partner, your investor, it's startup. We know everything is going wrong. Everything's going wrong. If you're like, oh, everything's working, everything's great, everything's on. No, it's not.
You know that's a lie, yeah.
No, it's not. And there should be. There's naturally, if you're trying to do challenging things, if you're trying to be the first one to do something, naturally, you're learning, and we want to pay to learn with you. I think of it that way. We're trying to pay to learn with you to get learnings and do something with it. Everything's not working.
So this might sound weird, the little Twitterverse thing, all the little VCs on Twitter now comment on each other's stuff and try to look smart. One of them said something smart the other day, and basically the description of a great investor.
Finally.
Yeah, was a good investor, good VC, is okay losing all their money in your company. Because everyone in their portfolio can carry the fund. And I lose $1 million on you, we lose $1 million. Not a big deal. Is that...
So I think it goes to your point before about knowing your investor, and Joe was talking about ask questions, due diligence, understand how their fund works, understand how they underwrite investments.
And whether they're dumb as a box of rocks or smart.
And all of those different pieces to really know what's on the other side, because if you've never read the book The Power Law, it's a great book about the history of venture capital and how it works. But if you look at most funds, most financial funds, they're trying to hit grand slams, right? That's the premise of it. Venture capital is generally not a home run business. It's a grand slam business.
Ooh, I like that. That's a good line.
I read it in a book. I saw it on a bumper sticker. So, but understanding that for your partner is really important, because they may make 16, 18 investments with the thesis that, hey, we're looking for 3 of these to generate 90+% of the returns of our fund. So the ones that aren't working, we're okay, because our investment thesis is more, we think you could have an outsized exit, but we know that X% of these investments will likely not work. But understanding that, if you go to Jim from TDF, or if you go to Carter at Updata, you probably have a good perspective, or hopefully have a good perspective of how they build their portfolio to understand what does success look like, or how are they underwriting the investment. And I think it's a really great exercise. At TMC, we did a deal recently where we gave the outcomes analysis kind of worksheet to one of the founders and said, look, here's the way we're thinking about this. What are you thinking? What do you think are the things that could go wrong, and how are you thinking about just these different scenarios? And it's a great way to build alignment, at least based on what you know today. So there's lots of different ways of doing it, but it starts with asking questions, and we know that everything is wrong. We know everything is going
Can I just put you guys on the spot? Just in the current environment, this past year, do you feel like this focus around, I've got a couple of winners versus, I'm willing to lose in some other areas, has that shifted?
We spend a lot of time on portfolio construction, and do we have the right percentage ownership in a company to make the fund work? We bet on good companies. A lot of them can have good outcomes. That doesn't mean it's enough for us. So we spent a lot of time on that. And I'll tell a story. One of my investors years ago was the first check in OpenTable. Y'all know OpenTable. Y'all have used it, right? It's a really cool, awesome product. And his explanation, he was the first angel check, 50K or so. And he told me the only reason that company survived was because it was .com bust, and the investor behind it, their whole portfolio was complete junk. and they didn't have enough money to defend them all. So they picked one, and they happened to pick OpenTable and poured all their cash into it. I don't know whether the story is true or not, but that's what he was telling me. And that one got its chance to have its shot on goal, and then it can make a fund. But so I do think good investors do understand their portfolio construction, and a lot of funds that are in a lot of exits do not make a lot of money because they didn't have they overpaid, or they didn't have a big enough piece of the hits that mattered.
I think I think what we're seeing in this market, where there's a lack of availability of growth capital, or
I'm in climate. There's more capital than God. I don't know what sector you're in these days, JR. You should switch.
Well, I don't see it. I think that the back end capital in like Series C, Series D, like later stage venture, that money is going to support existing portfolio companies, or there's folks out there opportunistically trying to buy stock in a secondary for a lot less than what it cleared on its last financing. I think there's an abundance of capital in the early stage part of the curve, but I think to the point you're making, what we're seeing from funds, or the question really, what we're seeing from funds is where within their construction they think that they're going to generate their returns. They're allocating capital to make sure those companies survive, and the ones that aren't, that's it. If they've probably written them down, or they realize they're not going to put more money into those companies and really focus their resources and assets
All right, so
to the ones that are
I
working.
like that. With that last word there, that's my number 8. Focus.
Number 8.
Right? This is actually our big one. Like, we call it pound the rock. Every company got a reason for being. You need to know yours, and we expect you to pound that rock. And if you start talking about other things, and doing too many things at once, or 3 products before the first one is selling, or anything that doesn't look like focus, I'm only giving you a few $1 million. That few $1 million, you need to spend it to go move the needle. And you can't go do 5 things at once. You need to focus. And half the time when a company that should succeed fails, and it's not the product, because it's usually the product stupid, it's a lack of focus. And they've frittered the resources they have until they don't have enough to win it all. That's our big one. After that, what I want you guys to do, if you will, JR, I want Joe, you give a sense. Do you agree, disagree with this? And then JR, if we can get the audience, see what's really out there, what people are feeling, that'd be great.
On the topic of focus, without a doubt, it starts with what we talked about earlier, which was the ideal customer profile, creating focus around that. Are you servicing the world, or are you servicing a specific part of the market? And then what are you doing for them? And then beating the drum around that consistently, so you can maintain relevance and then build the concentric circles around that core belief. So I'm in agreement.
Yeah, Joe gets a lot of credit for this, because if you look at their initial go-to-market, it was to a very specific customer segment in the IT managed service provider space, with a very specific use case around automated documentation, and they did that, right? And I think you guys did that really well, just finding focus, finding your segment, and having one clear value proposition, and just, what did you say? Pound the rock. They pounded the rock.
Pound the rock. Run between the tackles.
Pounded the rock.
Downhill. Run to daylight. Whatever analogy you want. And frankly, if you need to pivot, I'm okay. Many times we'll invest and fund you through a pivot. But great. I want you to find a different rock and pound that rock. I don't want you to try and run 2 rocks at once. That's just kind of beating your head against a brick wall. I'm going to try and get a couple more bad metaphors in here.
Brick walls and rocks. So yeah, look. Don't pivot sometimes I think has this connotation of a negative thing. You're learning, based on your learning, you're recalibrating. This is the way we should go. We learned this thing, that hypothesis was wrong, we're going to go do this. Go do that.
How do I do, guys? What's grade on the list of mistakes? Did we miss any?
One thing I would add, just adding on to some of the thoughts, is that as the founder, you're interacting with your board or your investors, I think you should have...
Some of whom are dumb as a box of rocks, yes.
Not gonna... you can hold your opinion.
He's not going there. He's not.
But with that in mind, keep in mind that the investors are actually in tons of board meetings, and they've got lots of companies that they're interacting with. And that's something it took me a little while to realize, because I would speak to something and I would expect that, they've carried the conversation from our last conversation. And I would tell you, it's important to reframe, beat the drum constantly and really kind of remind what's the issue, how do you frame it, and keep beating that drum. Don't underestimate how important that is.
Yeah, no surprises in the boardroom. Have your board meetings before they happen, and then execute where everybody's heard something. I'd say one thing that we didn't probably spend enough, and I think it was in like your org chart piece, Neil, is I think this is this is right up there, like oxygen and water. Always be recruiting. You are a recruiter. You're recruiting investors, you're recruiting talent, you're recruiting customers. And it doesn't mean
You
that
got to
you're,
sell
it-
stock,
it
sell
doesn't
people,
mean that
sell
you're telling
customers,
an-
sell the company.
Yeah, it doesn't mean that you're telling a story that's not true, but you're connecting with folks to really help them solve the problems that they want, to realize the vision and dreams that they want, and finding a way to connect into that. And that is probably one of the most important things that at least we look for. Is who's going to be a great recruiter? Who's going to be able to build a movement? Who's going to care about what Joe Allopat is doing and why they're going to want to follow him to what they're doing? And if you can't answer that question as an investor, you probably can't build an investment thesis.
Joe, any mistakes you made that I didn't make a list of here that you want to add so we
I
can
thought
all
this
know
was a
about your
1 hour.
mistakes?
I thought this was only 1 hour.
Oh. JR, any mistakes Joe made that he's not going to admit to that we ought to put out, throw out on stage?
I'll let Joe answer.
Colin, do you want to answer this before Joe does or after? No.
Where'd he go? So I would say have a really great appreciation for finding that virtuous cycle of product market fit, and then not forgetting that when you have it, that you can also veer off the road, and you really need to continuously be thinking about what's the next step. What's the next step? How does this expand further as you go through either multiple rounds of funding or you're going through your roadmap? I think it's important. We can't speak to this as an event that you do it once or you go through one round of funding and something happens and yeah, you've got it. Everything's great. You've got to keep continuously being watchful about what's happening in the market, where you fit, where the light bulb moments with the product, and what are those adjacencies you need to be tackling. So that's something that I'd say is not thinking of it as a single, it's a journey.
That
and it
means,
continues.
Joe, the mistake you made was veering off the road over and over until you got Colin? Is that what I'm hearing?
Well, yeah, that was one. Yeah, without a doubt.
Joe did a great job of recruiting, and I think I think one of the pieces, right, you exit some people in the business, but knowing hey, when is their fit, no longer the right fit. Mm-hmm. And I think that goes universally where some of the folks that got you to a certain place may not be the folks that are going to take us to other parts. And frankly, it's not because they're wrong or they're bad. It's just that their skill sets may not be right, to understand or how to do that thing. It would have been great to have Colin super early, but one, we probably couldn't afford him, and two, it would have been well, I need, you got me here to recruit other folks and to do other things, but you don't have the resources to do it. And I think as you think about some of those functions when you're growing, those folks that you're bringing on, it's not just they're really good at what they do. They're also great recruiters. They're folks that they could recruit other folks that are going to want to work with them, and where they're going to be a leader, and folks are hiring Colin to be their leader of who they're going to work with. And they're hiring Joe in that process of that's going to be my leader. So think about that as you're recruiting as well.
Okay, Christine, do we have time for questions?
We do. So I'll let JR, you want to call on audience members? If you have a
Yeah.
question,
If you have a question, raise your hand.
Sure, JR, CNC.
Josh up in the middle's got one. Josh back in Houston.
Wow.
He's got one.
What's up, Josh?
Does Josh work for you too, Joe?
No, he was at our previous
He was
facility.
Yeah.
Oh.
Hey guys, thanks so much for the talk. So I have a bunch of very specific sales questions for you both. Maybe I'll ask you later, but I want to ask a general one to the audience. Can you just speak a little bit more about that first sales hire that you bring on? And are you hiring a very senior person? Or are you just getting someone junior that can tell the story effectively? How do you think about that first sales hire?
I'm hiring someone who's my future VP of sales and is too stupid to wait. Yeah, and I'm hiring them a year before I need them. and I'm letting them burn my time and money, twiddling thumbs if necessary, so that I got customer feedback in, and I'm looking for somebody with range that has sold a bunch of different things at a bunch of different stages or has been through a serial number one sale, something that says they're not just hey, I can run a team in a process, they can sell the first one too. Yeah, that's what my bias is. But I'm pulling that trigger as senior as I can, as early as I can, and just choking down the cost. But that's me.
Yeah, so our initial sales hire was either employee number 4 or 5, depending on what you.
Sean?
Yeah. And so
Is
he
Sean
came
still
from-
with you?
He is.
Sean is?
And
Is he good?
Yeah, he's our VP of sales.
You can go try and poach Sean away from him, but
There you go. So he came from our target market, and so it was really finding the balance. I didn't think I was going to be ready to go top down immediately on my first hire. Some folks are ready to go do that, hire your CXO day one. I wasn't. I wanted to find really the person that would allow me to have some degree of room to step back, and they would lead at least to a certain level, VP of sales, targeting that type of target, and that's what we arrived at. And so early on, he was involved with the sales process, and I was there as well, and so he learned the product, and I learned through all of the pains that he had in selling the product very early on.
he'll come
listening
back
to the
and
phone
tell you,
calls.
this is, guys, the customer does not like what you're telling me, Joe. I need something different. And you need that feedback.
Yeah, I mean, the first quarter of selling that he did, he calls it the lost quarter, is what he calls it, when he really hit the street.
But you don't hire that
So,
dude,
yeah.
then you wait 6 months, you lose 4 quarters before you figure that
Yeah.
out.
Yeah, he gives you the salesperson, he or she gives you the reps that they're getting out there constantly. And the most important thing is don't pull back from that process. You have to be part of that process. Let them get the reps in, but be there and be present. But I would say find that sweet spot in the middle, the leadership capability, but not just the individual contributor, right? So they can own it.
Yeah, two thoughts. One, I think David Skoke from Matrix Partners calls it the trailblazer, right? So you're the founder, you're the CEO, you're the first salesperson. Document as much as you can about how that works, and set that person up to not only execute within it, but to make that process better. And the idea, I think, before you start hiring other salespeople, is let that person be able to make the sale or make sales without the founder being involved. That becomes an unlock to do so. And then if anyone here is familiar with SaaStr, Jason Lemkin, I think he's got a good pod on this, but go hire someone that you've bought from. Go think about the people that you've purchased from that you think are best in class, and go get them.
Mistake number 6, 7, don't micromanage
Yeah.
them. Don't let your insecurities be, I got to be in that room. They can't sell my product. I can't let them alone with a customer. You got to give them your A customers, and you got to let them sink or swim, or you're going to be the VP of sales forever.
Yeah, so if she or he is kick-ass salesperson, and you've bought from them, and you admire, how they go about their craft, I think that's who you want to go after.
I'd say one point I would add to that is also building that body of knowledge within your organization, written, I think is huge. It's something that I'd say, us at Lion Guard, we've done pretty well. I mean, Colin, you'd probably agree, our Confluence knowledge base is pretty expansive. We have meetings from the original sales meetings that we've had, and I think it's invaluable for, as you expand your team, that everyone has access to see how things have progressed, where the learnings are, and to not have that locked in people's heads. So we love Confluence. Take your pick of whatever tool, but you have to have that knowledge base internally so you can expand the team very rapidly.
JR, we got 1 minute before 5, but to be honest, if we spend more time here, SoftTech has to pay for less beer, so I don't think they'll be too upset, but I think we can get another question or two.
Yeah. Any other questions? Well, then let's not stand in the way of drinking. Any last words then, Neil?
Well, where are the SoftTech people? Where are they? Where'd they go? Where'd they go?
There's Pyle. Pyle's right here.
Right.
Right here in the front.
So you need to go upstairs and walk in and put your tab down. That's all you got to do. You hand them your tab, and then you tell them, when we hit this number or this time, tell me last call. But they can only serve so fast, so you can only spend so much money, and people aren't drinking like they used to, so I think it'll be okay. But we really appreciate you all coming. Yeah, There are only 13 venture capitalists in the city of Houston. We have a list. We're going to publish the list. Don't worry. Yeah, and I happen to be one of them. We got a couple of the others here with us today, and that's pretty awesome. So you guys all need to understand, we're doing this for you. I can talk all day long to hear myself talk. It's fun. But the reason we're doing it at the ION is because we're tired of saying the same things over and over, and we want you to actually start meeting the founders that are in the building, running companies, and asking them the questions and not the VCs that'll lie to you. And then we want you to actually go close some money and build a business, because the world doesn't move without founders.
Yeah, one closing thought from me that I think is important. You're going to learn a lot from each other. I think one of the things that makes the startup community work, Joe I think is taken just as much as he's contributed to this, but go talk to other founders. Learn from each other, be vulnerable, talk about like what's working, what's not. You'd be surprised. Find some folks who, are a year, 2, 3 ahead of you. Ask them like, what do they wish they knew then that they know now. But I think like that's the things like where things really happen is you start talking. You may find your co-founder. You may find like folks to recruit from.
You may get
but you'll learn
pollen
from each other
early.
It's the only way it works. Like for years we had like the Rice Alliance here in town, and that would like gather folks around, and that's where we all got to know each other. Like old timers like me in the community. And now we've got like so many more. We've got TMC. We have the ION. We've got all these like community programs that are going on. It's really on you to go meet other folks and be friends and talk to each other.
I'm going to add to that. Think of it like the Montessori school situation. Learn from the folks that are ahead of you. Commiserate with the ones that are in the same stage that you are, and then teach the folks that are at a stage that are behind.
Did you go to Montessori school?
No, I didn't. But
I visited my first Montessori the other day. Those are awesome experiences. Yes, we just need a little Montessori school classroom back here at the back, and you can come be have you been trained in that Montessori teacher model?
We're a post-oak family.
So you
we're
are.
in the boot camp.
Yeah.
Ah.
We're a post-oak.
We're just going to set up our own little startup Montessori in the back
Shout
room
out to
here.
post-oak.
I personally think environments like this, it naturally creates that cohesive type of environment where that happens. Those collisions do happen, attending events like this, but hallway chit chat, hey, how was it raising your first round? What is it like going, doing your first board meeting? There's just all those kinds of things you're going to learn from talking to another founder that's gone through this process, and I would tell you it's invaluable. I learned a ton. I continue to learn a ton by interacting with other founders.
All right, Joe, we need a drink now.
All right.
All right.
I'll shut it down.
All right, let's go get the tab open. Let's
Thanks,
go drink.
Neil. Thanks, everyone.
Thanks, guys.